Today's topic, how to best grow wealth through real estate leverage. Our aim today is to provide you with some timely insights that's going to help you navigate leveraging opportunities in light of stabilizing interest rates. I'm thrilled to be joined by seasoned mortgage professional Kevin Mercier. I've had the pleasure of collaborating with Kevin with multiple clients over the years. Let's dive in. Okay, so first up, let's take a look at this chart. Last couple of years have been pretty crazy. Interest rates went from the lowest they've ever been to the highest they've been in well over a decade in the span of about a year and a half. Thanks to my friend Steve Saretsky for pulling these charts, as I personally don't have a Bloomberg terminal. Now, for existing clients on the call, you probably have seen these type of charts at recent meetings, because I think this is a great way to illustrate just where we are and where we've come from. Asset prices in real estate and stocks went up dramatically during the pandemic because rates were so low. Now, when rates started increasing, the stock market got hammered and real estate prices have started to become a bit stressed. Frankly, if you increase the money supply, there's a fixed number of assets, prices are going to go up. It's just simple supply and demand. What wasn't clear at the time was just how aggressive our central bankers were going to be with increasing interest rates. Now, since February 2022, that's when they started increasing rates, but we haven't had a rate increase since the fall of last year. Now, if you've got a fixed rate mortgage, you've been enjoying that, I'm sure. You feel like a king when you're at a cocktail party, they're hanging out with your friends. But most people are in for a renewal this year or in the next year. And so everybody's going to have to be thinking about how are they going to leverage the current mortgage rates and current interest rates to grow their wealth from here. This is just a quick view into inflation. So inflation peaked at about 8.1% in June of 2022. Since then, it's been coming down as the Bank of Canada has been aggressively increasing interest rates. As long as inflation continues to subside, the need for further rate increases is likely going to diminish. Now, the question I'm getting from a lot of clients lately is, well, what about the stock market? So the stock market since the fall of last year has been on a bit of a tear. And I kind of like to bring things back to this chart. We've been through a Great Depression, 2 world wars, a Cold War, tech bubble, great financial crisis, COVID. We've made it through all of these, and profitable companies continue to make money. So there may be price changes depending on what's going on in the economy, but those tend to just be buying opportunities. This recession, if you want to call it that, has been a bit different. We've seen a lot of tech companies laying employees off, and we're seeing companies be more efficient. But ultimately, this is healthy for an economy, as much as it might suck in the short term, especially if someone's been laid off. So going forward, continue to own real estate, continue to own stocks. That's my recommendation, if you will. But ultimately, everyone's situation is different. So now I'm going to invite Kevin on, who's going to give you a bit of an update on the mortgage and real estate side.
The the mortgage market has been an interesting place, to say the least. It was funny when you put that slide up of the Bank of Canada key interest rate, and I got in 2007, and where we are today, and like my career literally is at the bellow of that of that chart. So what we're starting to see, and I'm really feeling it this week, is the real estate market trending upwards. Me personally, I actually put an offer into place 2 days ago, and it was accepted last night. So I'm thinking that I just lucked out and got in at the right time before it really skyrockets, because I'm feeling we were competing against one other offer. There's only 2 people that went through it. They didn't do like one of those like open houses where everybody kind of floods in. So we kind of lucked out there. But what you're seeing, like even the chart up here, 38.3% year over year in sales, right? Like in January, and I even felt like January was kind of slow. So maybe it's not saying much. Like as we're getting into the real numbers are really going to come out like March, April, May, where you're really going to kind of get the feel of it. Year over year prices still increasing. The listing rates up. So there is more coming on board. Like my realtor is sending out, on the auto emails, and I'm getting like listing. So you're starting to see a lot more supply coming out there, which is great. Unemployment fell to 5.2% in February for BC, so that's positive in the area. Obviously, the Bank of Canada is holding steady at the rate of 5% right now, but we are looking for our first drop in June. So most economists right now are expecting for a June first drop. So we'll see how that plays out. Nobody really has a crystal ball, so every month we get statistics and like there's kind of some shocking information in there. So we'll see how that plays out. But in general, most economists are actually expecting by 2025 a 3% drop from the key overnight rate. So we'll see, that's where we're trending. So it's kind of like everybody, that's why you start to see the real estate market pick up, because everybody's getting that urge to go out and buy because they feel like we're going to get into a better spot, and everybody's got that positive energy going in them, and it's kind of starting to spiral out there. So look out for that. And one shocking and even Brandon questioned me on this one. I sent them the article. 80% of all mortgages are up for renewal this year. So, and I am one of those people. So, out of 10 people on this call today, 8 of you are renewing this year. So give me a shout if you need help. A lot of people are going to get sticker shock this year, right? Because you're going from, my rate was 2.25, right? So I'm going from a 2.25 and doubling it, pretty much. I'm doubling it, right? So what's my payment going to look like? The great thing is that we have products that can help you. We do, as long as you have some good equity in that home, we have products that can help you balance off that payment, right? So you can kind of like, I've got one product where you can kind of like select what you want to put in and just kind of lean on your equity as you need it, right? So there are products out there. Just make sure that you lean on somebody that you trust and you can help you through the difficult time until rates come down. But most clients right now, I'm putting into a 3-year rate. That's where the best value is. The clients that can handle the variable up front, because it's relatively high, you're in like the 6th percentile range. There's some that are doing that, and then they're going to wait till the BOC knocks down the rate and kind of feed off it from there. So why invest in real estate? It's a I got into this industry, and it was a big objective of mine to live in a property, take out the equity, buy the next property, take out the equity, buy the next property. So I would kind of I went from a condo to detached home to another detached home. And one of my detached homes had a basement suite in it. So, it was a really perfect landing spot where I got to get to the point where I really didn't have a mortgage payment because the rent covered all my expenses. So you'll see in real estate, like the vacancy rate in Vancouver is 0.9%. So it's like the most minimal risk that you can do. And I'll talk about it in the next couple slides about being a landlord and the things that you can go, because obviously being a landlord comes with risk when you're dealing with tenants, right? The tenants are protected pretty good in this province. So but I have some, like, I've had one relatively bad tenant, but not bad at all, really. Like it was all manageable. And I've been doing it since 2008. So if you do it right, it's very fruitful. So, you know, uh, growth 4 years in housing prices, 33%, like that's massive, right? And the growth year over year, even over difficult times, is 8%. It's funny, kind of in inflation times, real estate goes up. A lot of times in inflation, like real estate goes up with it, right? So like you're really hedging your bet on putting your money into real estate. So low risk, high reward, profit from equity buildup, mortgage pay down. So you'll see that go through. So I'll go through some examples on that. Sometimes you'll get positive cash flow. Right now, maybe not as much, but if you can get neutral cash flow, that's like what you want. Because at the end of the day, you're making your money off the equity that you're building in that home. Okay. And then the tax benefits, there's cash damming. I'll do a whole other session on cash damming. Smith maneuver stuff. Like there's a lot of tax benefits that you can latch onto as well when you have real estate investment. Talked about hedge against inflation, leverage growth of initial net investment. Think about like, okay, I've got $200,000. I'm buying a $1 million property. Okay. Now, my $200,000 isn't earning off $200,000. It's earning off 1 million, right? So 5% of 1 million is a lot more than 5% of 200,000. So you're really just leveraging that investment that you're putting into it. And it's an amazing, great retirement strategy. It's been my strategy my whole life is obviously I work with Brandon, I invest with Brandon. It's about having a full 360 mix on your investments. I put in a little funny quote in here: "Landlords grow rich in their sleep without working, risking, or economizing." And if you actually operate as a landlord, which I'll show you that you don't have to, like if you're operating as a landlord, you have to work a little bit. So, but there are routes around where you can actually live by this quote. So, just threw that one in there. Okay, so becoming a landlord, like it's not for everybody. I realize that. But for those that can't handle it, handle being a landlord. Like I've been a landlord my entire career, because I felt like I could handle it. I'm pretty handy around the house. So dishwasher goes bad or carburetor goes down, like I can work with it. But not everybody's going to be in that realm. Always pull credit. That's my biggest one. Always pull credit. And a lot of clients, a lot of applications that you're taking in for your rental, you can ask them to go to like Credit Karma and pull credit there. So they have to provide that to you. If you're working with me, I can pull credit for you, no problem, for clients as long as we get consent. So happy to do that for my clients, because I work with a lot of clients who are investing, who are upgrading, who are doing different things with their real estate. So take an application every single time. I want to point out the two next categories here: online property management system. So there's an application that I used to use. It was on Pen, or I still use pen.do. And it's an all-in-one like system. So you take an application on it, you can manage all your applicants that come in. I think they were starting to build in that you can pull credit on there too. So that might be an opportunity there if you're not leveraging me or Credit Karma. But it's highly important to keep organized in that process. I always hated when tenants were leaving, but I loved it too because every time a tenant leaves, guess what? You get to charge a new rental rate at that point, right? Whereas if a tenant stays in there, you're 2% per year. But if a tenant leaves every year, what you're gonna find in like if tenants are renting out a 2-bedroom, your average is probably a year and a half that you're gonna get that tenant in there, sometimes two, because they're looking to upgrade, right? So, and then same with one. If you have a 1-bedroom, it's like unless you've got an older retiree in there, they're going to be moving out too. So depending on the type of client that you put in there, but you can kind of strategize with that as well. So what I want to allude to here, if you don't want to be a landlord, that's why they have property managers. Okay, so property managers come into play. They take care of the application. They take care of the interviews. They work with you on selecting the right candidate to rent out your property, and they charge you a percentage of your rent, which is about 5 to 12%, depending on the services that you're employing them for. So that is a really good way to go about it if you really just don't want anything to do with being a landlord. Okay, but note that like having investment property is one of the lowest risks that you could possibly have within within this program here. So. All right, so I just wanted to kind of allude. So we're going to go through a couple examples here. So, let's pretend that we've gone out and we've bought a value home at 950,000, and that mortgage was 760,000. So our equity at the time was 190,000. We put 20% down. Okay. And by year 5, and I'm using like pretty conservative numbers, like 5% in the Vancouver Lower Mainland area is actually quite conservative. It's probably more in the 7 to 10% range. It's been over the last little bit here. So, what you're doing there by your $190,000 investment that you put in there, you look at year 5 and now, okay, so your 950s turns into 1.15. You now have $445,000 in equity in it. And then by year 10, you're at 1.47. So the house that I'm currently in, I bought it in 2016. I bought it for just over $600,000. And the house now is worth about 1.6 million, right? So, look at that gap in there. and think about this is the Vancouver real estate market that can be so fruitful. And there's a lot of people that I see that are kind of scared of the investment purpose. And I see all this money sitting pretty much in their account. Like think of it as a bank account. Like, okay, so you got in, I bought this place for 600,000. My mortgage is like, 350,000 now, right? Over the time that I've been here. And if I wasn't savvy, then the 350 to 1.6 million that it's worth, all that money's just sitting there doing nothing for me. So why would I have it sitting there doing nothing for me? Why would I not invest it back into the market? Right. And so if you're savvy enough, what we can do is we can take out, so in year 5, we can take out 215,000, right? Because we refinance up, the max we can refinance up to is 80%. So we refinance back out, we take out 250,000 and we put it back into property, right? Or if you're kind of at year 10, everybody's scenario is going to be a little bit different. You got more money. So you got 500 and, sorry, my screen's like blocking, 568,000. So you'll see in the next slide here, we're going to go through 2 scenarios, okay? So we're going to take these year 5 and year 10 scenarios, and we're going to extrapolate them. So here's scenario 1 from the first example. So we take that 215, okay? Take that 215, we put it towards another purchase. So a 20% purchase on 215, so 20% down, 1.075 million, okay? Mortgage 860, your monthly at today's rates, 47.18, okay? And this is only going to get better over time. So if we put you into like a 3-year rate, that's what your monthly payment's going to be, okay? But at the end of 3 years, guess what? That monthly payment's actually going to go down because of where we're going with interest rates, okay? Our rent rate now is 5,000, okay, for that detached home. So you're netting, in this example, 282. Every example is different, but I'm obviously using a positive cash flow situation as an example, okay? But just think like at year 3, when we renew again, say your mortgage rate goes down to, because what I would say, like when we renew, we just refi and we extrapolate back out to 30-year ag. Because at the end of the day, it's about cash flow, right? And all the interest that you're getting charged is a write-off on the revenue that's coming in the door, right? So it's a personal write-off that you can use to your income. And then your old home, or the home that you're still living in, if that's the way you're doing it, your equity stays at 230, your value is at 1.15, your mortgage is higher now, so 5,000 is your payment, but your net payment is 4,738. Okay, but now you have 2 homes working in the market. So home 1 at the top there, and your investment property. Like it's just like when you look at it and see how much equity that you earn, and you think about retirement, and you think about earning net worth, like this is how you do it, right? So, at the start, year 1, 1.15, and you've got a 1.075 at year 1, okay, in a conservative manner at 5% per year, you're at 139, and then you're at 131. Total equity 1.06, right? So now you have $1 million in equity. Look at year 10, we're almost at $2 million worth of equity based off your mortgage going down and your value going up. And if you surround yourself with a team like myself and Brandon, a property manager, a realtor that you love working with, we're all going to work together, because if you win, we win. That's the way we want it to work, right? It's a win-win-win. And at the end of the day, like I want my clients, like in 10 years, when I look back and I see that client and that client and that client, all with $2 million net worth, or 3 million or 4 million or higher, and I had like some impact in that, that's going to make me feel good and sleep at night. Okay. And we're here to help in any manner that you like, and advise in making this happen for you. Okay. So scenario 2 was the 10-year term, where you actually have a little bit more equity, so you can take out a little bit more for a down payment. So we're taking out more in that down payment, but we're going with the same value of house. So your mortgage is less, right? So your monthly is less. So now you're actually netting cash flow in this one, right? You're netting like 2234, right? So now your mortgage in the other one has a monthly payment of 6417, but the net is 4183, right? So every time that we do this, your actual mortgage that you're paying is getting less and less and less. So if you copy paste, copy paste, copy paste, you're eventually at the point where I got to, where you actually have no mortgage payment whatsoever. All the revenue coming in is paying all the expenses going out. And really, it's just like, you see it in this way, obviously the numbers go up, right? So you're going from an equity position of 862 at the start to in 10 years, you're 2.52 million, right? So, the power of equity can get you a long way in real estate. And, my biggest advice to anybody on this call right now is just surround yourself by experts, surround yourself with people that can provide information that you don't know. Because like I latch on to Brandon because I know nothing about the market, right? I latch on to my realtor partner because I know nothing about like purchasing and selling real estate. Like I kind of do, but I need like that expert there, right? And property manager, exactly. Like it's not my expertise. So, surround yourself by people that cover your shortfalls, right? And that would be my biggest advice from this session. And people that you trust, right? And just at the end of the day, I want all my clients to succeed, and I want to see them with massive net value, like when they're in their retirement ages. And then there's things that we can do in retirement, right? And leveraging equity and I just want you to put your money to good use, right? If your money's just sitting there doing nothing, like you put it to work, right? All the top people, all the biggest earners in this world are smart enough to put their money to use, right? And that's what I want you to get out of this session today. So
Yeah, and I love what Kevin said then there. You ultimately want to build your professional advisory team. So the financial planner, the mortgage professional, the real estate professional, if you're not wanting to be a landlord, getting somebody to help you manage those properties, you want to build out your team. The wealthiest people in this world don't do everything themselves. They're not DIY for everything. They leverage the professional expertise of those who can help them get somewhere faster. And the quicker that everyone on the call realizes that, the quicker you're going to build your net worth. I certainly wouldn't have gotten to where I am if I tried to do everything myself. I leverage the expertise of people like Kevin, people like Ryan and Steve, who will come on shortly. And that's helped me in my wealth building journey. Now, of course, some of the scenarios that Kevin walked through, everybody has a different level of risk tolerance. And so I'm going to talk about a few other things that you might want to consider as you're building wealth. Real estate, an integral component, but not necessarily the only piece of wealth building. And so I think it's important to balance that approach. First up, the first home savings account came out last year. For those of you that already own real estate, this is not relevant for you, but if you have friends or family that are looking to buy their first home, if they have questions about the FHSA, feel free to connect them with us. We're happy to chat with you about them. It blends some of how the RRSP home buyers plan worked with the tax-free savings account. Ultimately, people don't have to repay the money that they take out for the first home savings account, and it can only be used for that first home purchase. So for folks like Kevin, myself, and many on the call, you can't use this, but good to be aware of it. The government introduced it last year, adding a little bit of fuel to the real estate fire that I thought would maybe burn out with higher interest rates, but as Kevin has shown us, it's not necessarily doing that. You will get a tax deduction if you contribute to this account, similar to how the RSP works. Another thing that came out very recently in BC is the tax exemption for property transfer tax for the first home purchase is now up to $865,000. Previously, it was only $500,000. So for any buyers who are entering the market this year, that's good news for you. Pretty sweet time to buy your first home. FHSA plus that property transfer tax exemption, which in Greater Vancouver was much needed. You can't get anything for $500,000. So now, when the market's going up, leveraging can be fantastic. As Kevin mentioned, you can write off the interest against your investment loans or your investment properties, which is going to allow you to magnify gains versus simply saving on a monthly basis and investing. During today's economy, in a rising interest rate environment, with the cost of your loan going up and the value of your assets potentially going down, that might be a tougher spot to be. So you want to be careful when and how you leverage. The goal isn't to always take out all of your equity with all your assets and be fully leveraged all the time. But when there's opportunities in the market, that's when you want to take on more leverage. either in the equity markets with myself or in the real estate market with Kevin and your real estate professional. Most clients use a combination of these depending on what's going on in their life. And I'm going to walk you through an example of that in just a minute. Ultimately, Kevin and I are not suggesting everybody gets over leveraged into very speculative assets like cryptocurrency or marijuana stocks. We're trying to say do conservative leveraging and use the tax code to your benefit. That's what very affluent people do. That's what we're doing. And we encourage you to consider that for your own financial planning as well. Okay, so this client scenario, I had a client in 2019. They purchased their principal residence. It was an apartment. In 2020, they leveraged into equities when the markets took a big drop. That gave them some tax-deductible interest over the preceding years. In 2023, this client was actually on maternity leave, so their income was lower in that year. They then sold off their leveraged investments. There was a capital gain they had to pay, but because their income was lower that year, it wasn't a huge tax bill that they had to pay. 2024, they were looking to move into a larger home, and they actually are in the process of buying a new principal residence. They're going to retain the existing apartment and rent that out, and they're taking out equity from that into to put into the principal residence. Because as Kevin mentioned, your rental properties, that's where you want to keep your larger mortgages because that's tax deductible interest. Your principal residence, you probably want to avoid having too much debt there because that's not necessarily tax deductible. At the end of the day, if you don't take away anything from today, if it goes over your head, the 3 rules of thumb always are going to stand true. Work with advisors you trust, maintain emergency savings, and always pay yourself first. Up until 2022, I never recommended high interest savings accounts, but if you're looking at buying property, starting a business, or you just have cash you aren't sure what to do with, the best high interest savings account I've seen is paying about 5% right now. Why I like these is the money's redeemable anytime. I'm not a big fan of GICs because it ties up your money and you avoid potential opportunities, like say in real estate or the equity market. You're not going to get rich using a high interest savings account, but not a bad place to temporarily park cash until you're ready to make some moves. I've also lately been moving more clients into bonds since you can also get paid 5% just to wait. And when rates come down, bonds are going to be appreciating. And that will be taxed in the form of a capital gain versus interest income that you would get from, say, a GIC or a high interest savings account. So the reason I wanted to bring Ryan and Steve on, first of all, Steve puts out a lot of great content, as does Ryan. So if you don't follow them on social media and you're curious about the real estate market, I encourage you guys to follow them on social media. But they're sort of boots on the ground. They're seeing what's happening on the real estate market. So between the 4 of us, you're gonna have a pretty well-rounded view on what's going on in the market. Let's maybe start with this. Would you recommend looking at other markets for investment properties, such as Alberta, instead of keeping all of your real estate in Vancouver?
Yeah, I mean, it always depends on like your planning goals, right? I mean, personal circumstances. I mean, I think it makes sense from the angle of, cash flow is better. You're not going to get the same level of appreciation, but you do have more friendly landlord policy, there's no rent controls, etc. So it's good from that angle. I think it's always just a matter of like, do you want to manage a property long distance? It can definitely be done. I mean, I certainly do it, but I also like I'm in the industry. I have a bit of a higher risk tolerance. So I think it's just kind of weighing the pros and cons because, like I said, obviously, like to give you an example, if you're buying, let's say, a 1-bedroom condo in Vancouver, it's obviously 30-minute drive or whatever to where you live, so you can manage it yourself, right? It's very hands-on, it's tangible. Something's broken, you can be on site really quickly. Whereas like if you're in Calgary, most likely you're probably hiring a property manager. You're paying them 8% to manage the property, and so that you have to factor that into your returns. So that's kind of what I would sort of say. So it's just kind of weighing the pros and cons.
Yeah, I would kind of like pipe in there and just say like if you're just getting into real estate investment, you'll probably want to stay more local. just to kind of have more of your hands on it. And then like where Steve is, he's probably like in maybe that was your third or fourth property. I don't know, but where you can kind of
Yeah,
diverse it a little bit
yeah,
and
that's not a
expand.
bad idea. I
Like
tend to
you might see an opportunity where like, oh my God, this is great, right? And you know, it could be on Vancouver Island for all you know, or in the interior. I'm working with a client that was looking at a fourplex in Salmon Arm for that was netting really good returns. So you know, it's just I don't know for entry, I would just you know kind of step by step
I
sort of thing
I would
would be
tend to
my
agree
comment.
with that. I would tend to agree with that. I think like yeah, I mean, I think it's easier when you have a bit more scale. Like if you have multiple properties like in one market, like obviously there's just economies of scale. You can keep costs down. You have better access to trades. You build up a better network over the years, so it's easier from that perspective. So yeah, for your first one, it might make more sense to be closer where you can actually feel it and touch it.
Yeah, and like I'll just from my personal journey, like I was the one that like lived in a property, refinanced, then moved to the next like upgraded properties, then rented out the property that I knew, which actually gave me more confidence because I was like, I know that property, you know. So that's another way that you can kind of do the leverage thing. It's just kind of like move up as you're graduating homes and keeping the old home.
How do you find the costs out there in Alberta, Steve, to like renovate and do your contracting stuff remotely? Because for like us, like when I think I've told you guys I have some property in Prince George, the contractor fees just so much more expensive. And just for comparison, we're doing a reno here locally, and just being able to manage your own trades and just kind of shop around. It's not necessarily your general contractor out there would do all the procurement and get 3 quotes for everything. They'll just probably get whatever's available. So the cost for everything is just generally a lot more, but maybe Alberta might be an exception. I don't know, things out there are just
Yeah, no, I found the cost fee in Alberta to actually be like quite low.
that's it.
I mean, I definitely feel like I've got a good network out there, but I know where you're coming from. Like that makes sense. But yeah, we've contractor wise, builder wise, been able to get some pretty good rates, much more attractive than like what we're seeing in Vancouver.
Mhm.
Um, but yeah, I mean, there's ways to do it. Like I said, it just depends. Like I said, I'm in the industry, so I have a bit more maybe of a skill set than someone that is a full-time accountant and does real estate like part-time. Like that's going to be harder to do maybe remote real estate, right? So
Yeah.
Yeah, keep in mind that folks who have on the call are like very bullish on real estate. So it's not to say everyone needs to own 5 or 7 properties, but it is something you want to understand how you can do it when you're ready to do it. But great question, Stephanie. Thanks for that. Next question we have is from Willem. He's asking, do you have any stories of people who over leveraged? He says further on that leveraging debt is a great multiplier of gains and losses. I've heard of success stories, but rarely hear of the stories of over leverage. I've got one, but I'll kick it to the audience first, or sorry, the panel first before I jump in.
I mean, I can't say I do. I mean, obviously, I'm not as involved on the lending side, so I'm kind of curious from Kevin's perspective. But yeah, I mean, I think that I see over leverage people on their primary residence where you're taking out too large of a mortgage. People are almost living uncomfortably and having to sort of cut everywhere else. And yeah, I mean, I think to Kevin's point, I'm not on the leverage side, I'm less of a fan of leveraging like your primary residence and having like a huge overhead that you have to feed, as opposed to having some debt on your investment properties where like ultimately the tenant's taking care of that payment.
Yeah.
Yeah, like what I've done, if it's primary residence, is breaking up the mortgage. So like if you're taking out the down payment from your primary to go to your investment, a lot of times I've like had products where you can segment the amount of money they've taken out so that you can leverage the charge of interest there and track it going to your next property. And I haven't had any failures with it because I find that like if you have like a team like this working with you, it's like we don't allow you to make horrible decisions, right? Like we don't allow you to like leverage your money to invest in some random like crypto stock or like things like that, right? So it's if you're investing into real estate, you know 10 times out of 10, you're probably going to succeed.
Kevin, like you can get the cost and then basically get your rental. And if it cash flows or you got a good debt service, that's even
Yeah,
below
it's
20% buffer, you got a good down payment. It's pretty
cash
tough.
neutral. If you can get it to cash neutral, right? Like that's ultimately like what you want to do, right? And right now it's a little bit more, more just over cash neutral, like, just like 5% or so over cash neutral is more or less what I'm doing right now with some of the clients. But knowing that like come 3 years from now, when we renew, it's going to be the other way, right? Because now we're probably going to be cash flowing on that property. And you'll want to be like like you'll be taking out equity from your rental property, putting on your principal residence, right? Because you want your investment property to have the higher mortgage than your principal residence, right? So if we refi your equity property or your investment property, take that money, put it back on your principal residence, right?
So I'm hearing a couple of things. One is some people may be biting off too much house for their first property and having too high of a mortgage. That's probably a big risk. They lose their job, they've got a big mortgage, they don't have rental income coming in. That's obviously a tough place to be. Another story that actually scared me away from encouraging clients to leverage too much was folks that borrowed money in 2007, put it in the equity markets, and the equity markets tanked, and then they lose their job. Because then you've got a situation where you can't service the debt on that investment loan, but the investments actually dropped quite a bit. So instead of having 100,000, maybe now you've got 65,000. You don't want to obviously sell those investments because you're still gonna have to pay that full $100,000 loan. So that kind of cautioned me a bit before I got involved in the industry, and that's made me be a bit more careful about how I encourage clients to integrate leverage into their portfolio. But it is a wealth magnifier. It can also be a wealth destroyer if you're getting your advice from one person that might not have a full view into the whole market. Having an advisory team is important because Kevin knows a lot about debt. Ryan and Steve know a lot about real estate. I know a lot about the investment markets, financial markets, and insurance products. That's going to help give you a well-rounded view into any decision you make. So don't just hear some information online and make a decision. You can ask your professionals about what they think about particular things, but that's why you build a team. Okay, our next question is coming from Andy. As a mortgage lender, how would someone retired purchase a property with $350,000 down payment and no equity? Is that possible, Kevin?
Yes, it is possible, but we're looking at like a 50%, sometimes a little bit lower loan to value. With enough income, retirement income. Like I've got one product, it works as a reverse mortgage without an age restriction, or you can do it with an age restriction. Where you can do 44% loan to value and they like literally don't look at any income, but you also don't have any mortgage payments. So what happens is the interest accrues in a reverse mortgage and you don't pay that interest until you sell the property or you refinance out. Okay, so that's an option. Manulife has a product that you can at 50% again have very similar, where like the risk goes down. So the lower the loan to value, the lower the risk, right? So the more lenders are able to lend out for you, right? So if you're retired, there must be some sort of pension income. There must be some income coming in for your retirement, which can be leveraged as an application, as part of the application. So it's definitely doable. It's just 350 is going to get you like 700, right? So it's like 350 if you have income, it's going to get you a lot more, right? So
that's good info. Yeah, for retired people, I generally say you're gonna have a hard time, but good to know that there's options if they still.
There's definitely options out there. Usually a little bit higher rates. The Manulife one actually is pretty good. It's like their standard rates. So that one's pretty good. The reverse mortgage one is about 8.4 right now. I'm actually doing one of those right now. So that's been a popular product for certain situations. So
next question here for Ryan. What do you see the current real estate market looking like this year compared to previous years, and what factors do you think are driving those trends?
Yeah, it's pretty funny. I think so far this year has been a very big mirror to last year so far. Just having a hot start to the year with a lot of people, rates, fixed rates coming down, the potential for the idea that variable rates will come down soon. So people are getting pretty excited. They want to get ahead of the curve. So we're seeing a lot of kind of the multiple offers starting to come back again. Buyers coming out to go shopping. We're not necessarily seeing things sell for like 100, 200K over asking or anything like that, but you're seeing things sell pretty close to asking price, or, just above or just under. And, we'll see what happens with the rates going down the road, if they do in fact come down, or if it could happen the same thing as last year, where they end up surprising people, keeping the rates up higher for longer, and then the second half of the year is quite quiet. So that'll be interesting to see what happens. But so far, it's been a quite active start, and very similar to last year in many ways. Yeah, it's kind of, I feel like the last 2 years have been very similar for whatever reason compared to the other ones. Yeah.
And which neighborhoods or property types are, and Steve or Ryan, feel free to chime in on this. Are you seeing like more opportunities than perhaps previous years?
I think we had some good buying opportunities in the detached market. Those are definitely gone. That market's super tight. I feel like the downtown condo market's still like a decent value buy. I mean, it's still a slow, stagnant market. The prices peaked 5 years ago, haven't really moved anywhere. So
Yeah.
Depending on your view on the downtown core, the office market, all that other stuff, like it still feels like there's a bit of doom and gloom there. So I think like you can go and pick up some good deals, negotiate.
Yeah, I was gonna say downtown as well, actually. You can get some surprising stuff, like pretty nice buildings for 1,200 a foot, good rental market. And like Steve said, the prices in downtown haven't gone up a lot since COVID. Hasn't had a big spike. So the value is still quite good compared to the rest of the greater Vancouver area. It's funny, it's almost too, so I got, even like Langley's condo market's quite quiet compared to North Van. I've been looking with some clients in North Van. It's been quite active. I'm working on a project for myself as well, renovation project, and just looking at this, watching the listing, that it's just pretty insane how active the North Van market has been. But in terms of opportunities, yeah, I mean, I think you're not really going to go wrong buying anywhere. But the other opportunity could be where there's going to be more density for the transit-oriented developments coming in along the Broadway SkyTrain line. There's, along Fraser Highway out to Langley. There'll be some future hotspots, and the government has basically put online where those transit-oriented development radiuses will be. So I think if you can buy something near those little pockets, I think you'll be doing pretty good as well.
Definitely some opportunities there. But yeah, make sure whoever you're working with on the real estate front has some inside scoop data that can get you into those opportunities. I know I've had a client recently who met a client or met a real estate agent who's a bit newer in the business, and they probably wouldn't have that insight necessarily. So, now question for Steve. I know you follow a lot of the kind of economic factors such as like inflation, interest rates. What's your forecast going forward here? I know you follow what's going on with the government. What would you say is going to come into fruition this year that is going to impact real estate, positive or negative? Crystal ball time.
Yeah, man. I mean, forecasting is kind of a crap business, so I'll kind of stay out of that. But I think here's what I'll say. Like on the forecasting side, it's like think about it as like how unpredictable the housing market has been over the last, let's call it 4 years, right? Pandemic hits. You get the highest unemployment rate we've seen in many, many decades. 18% of people deferring their mortgages, and then housing rips to all-time highs. And here we are 500 basis points later on, the fastest rate hiking cycle in modern history. And the housing market is really just holding up kind of fine. I mean, detached market in particular is almost back to all-time highs. So it just shows you like it's hard to predict. I think that what I would say is just manage the risks right now. I don't think it's time to give the all clear and say, hey, party on. I mean, like there's still a lot of challenges that are out there. I think that, there's a lot of narratives out there. Hey, rate cuts are coming, get in, buy now, buy now, buy now. It's like, I don't know. I mean, we'll see. I mean, I think that, we can't be surprised, right? I mean, the Bank of Canada, I think, is guessing as much as anybody right now. And so, we're going to get, two rate cuts, 3 rate cuts, 4 cuts. Maybe we get none. Maybe the first one comes next year in 2025, right? And so I think it's just, don't buy on, speculation that, rates are coming down and prices are like, we don't know. And so I think there's still a bunch of risk out there, and I think it's time for people to have a bit more cash and be prudent and wait for the opportunity.
Next question that's come in here. Thanks for that, Steve. What would be the case for rates to stay steady in 2024 rather than coming down, as the market seems to be pricing in? I think June was what Kevin had mentioned earlier. What kinds of opportunities might present in this scenario as we go longer and longer without a cut?
I think it all ties down to like looking at inflation, right? Like, but part of inflation, gas prices, food prices. We're starting to see like gas price. What's gas at right now? 190, right? Like, I just filled up my tank and I was like, oh, it's felt like I got punched in the face. It's really tough to say. We listen to these economists, and God, like the amount of economists that are wrong, like why are they even getting paid for their job, right? But like it's just like, we've got wars going on overseas, like, there's different things going on, and there's different things at play that, like I think, what Steve said is kind of just, be relatively prudent with your money. Um, find low risk situations, right? And real estate in the lower mainland over time has been a low risk situation, right? So, unless we have an earthquake that just destructs everything, or a world event that destructs everything, I think you're pretty safe with it. If you calculate the numbers, if you actually get an accurate rent for what that property is, which is pretty easy to do, right? Like, you just go on Marketplace on Facebook or whatever and look at all the rentals available. Employ, I think Kevin Axter, the property manager that I'm going to be leveraging a little bit. So, employ your experts around you. So if you calculate the numbers, it looks like a safe risk, then go. And that's when we were talking about like investment locally, I would keep it local. Like that would be me being prudent with my money. Instead of going to Alberta, which I know nothing about, right? So, if I was from Alberta and I saw an opportunity, I'd jump on it, but I'm not. So I would just say be comfortable, follow your gut, surround yourself by professionals, and that's all you can do.
Yeah, Steve made a good call on Alberta previously, but I do have a client who bought in Calgary back a decade ago, and then there was no growth for like
Sean McPhee. He should be on this one. I think it's a mutual client, right? Like I think he just sold it last year. So,
yeah,
finally.
yeah.
He had no
Luckily, he
growth.
held on. He
No
held
growth
on.
whatsoever.
Yeah. So
He's like,
Yeah,
I want to
that's
get
the
rid of
thing.
this property.
That's what you're buying too, right? I mean, I think that's the thing is like, like everyone's like, everybody always tries like, oh, I'm going to time the bottom, or like, it's like, there's always a deal. Like there's always like, even in a bull market, I think you can get a deal, and same thing with the Calgary, right? It's like, if you're buying pre-sale condos in Calgary, like, yeah, you're probably not going to make any money. If you're buying inner city dirt that has the opportunity to be upzoned, like, yeah, you're probably going to make some money, so the different product types too. And yeah, I would just tell everybody, like we saw at our clients, everybody's waiting for like the home price index, like on the chart to like bottom. And then as soon as it bottoms, like, yeah, I'm going to buy once it's starting to like, it's like, we don't know.
Never
Like,
works that way.
You buy when the sentiment is bad, right? I mean, the worst sentiment I've seen was like in, September, October of 2022. Those were the best deals. So even though mortgage rates are actually higher today than they were back in September, October 2022, the best deals were then, because everybody was worried about interest rates and how high they would go, and there was not a lot of certainty.
Yeah, like it's so hard to chase the peaks and valleys, right? Like, like I would say if you bought like in January, February, like you probably did pretty good right now, right? Because I'm feeling the pressure of a market that's just about to like explode pretty soon here. So, and I'm sure Steve and Ryan probably feel the same thing, right? Like I was in it, right? So I know, right? I feel it, and I'm like, thank God I did it now instead of like 2 weeks from now, even, right?
There's just
And
pent-up demand too, and it's crazy how the investors haven't really like entered the market. It's just been a lot of it seems like anyway to me. It's just been a lot of end users and people that have been waiting for the moment to buy, and it seems like that's just a fairly common theme. And so you have this huge pent up demand that's kind of entering the market now. Never mind when rates actually, you know, if and when they do drop, investors coming into the mix will only make it crazier. So yeah, I mean, it's I forgot what I was going to tie into that with, but I was just going to share that. It's been a lot of end users buying right now, people just that need homes. And also, oh yeah, when you're looking at the homes too, it's nice to look at comparables. Obviously, like it's nice to know that you're not buying and setting a new record in the building. It's nice to know that there was someone that spent more money than you at some point in time. So there's probably, you know, there's some cushion there to some degree that, yeah, I mean, it's not really, I still don't think it's the time to be setting all-time records, but if you're buying and you've got some good equity into it based on the comps, then I think that's, you know, it's a good cushion to have going into it.
I know there's this guy on Twitter, Vancouver housing collapse. I see him on Twitter posting stuff, and I'm like, this guy's been doing this for 10 years. I'm like, he could have been rich if he just did the opposite of what he's been saying. Or like it's like there's Peter Schiff, the anti-Bitcoin guy. These guys are just wrong. Like they were wrong. There's no other way to look about it. And so just indecision and like sitting on cash and not doing anything, like that's the worst thing you can do. Whether you buy a detached house here, a townhouse in Coquitlam, or rental property in Vancouver, at least you're owning assets and you're benefiting from the economic system in which we live. Unless you're a doomsday type person, in which case, yeah, you know, just set your bunker, get some guns, and you know, call it a day. But most of us, I think, are not that. We're trying to build wealth and take care of our families and live a high quality life. And so if you get stuck in sort of these online rabbit holes, you can avoid you can get into situations where you're not building wealth, and we're trying to help you not be in that situation. Okay, we got a couple questions here from Willem. Are there opportunities with pre-sales where people aren't able to afford them with the new mortgage rates? I'm guessing he means people that can't close on a pre-sale. Who would like to take that one?
I can start. Not my clients. I think most of them usually pretty stern when we're buying pre-sales running. Like we usually with pre-sale, you want to look at what you're paying at the premium because there's usually a bit of a premium priced in. So we like to make sure that you're not paying ridiculous premium on it. It's a reasonable appreciation level to hit. But are you seeing stuff in the marketplace come up? Yes, here and there. If you look, you do see it here and there. There's a tower in New Westminster my brother was selling about 300 units, and of those 300 units sold out, about 20 contracts came back on that one. That just closed last month, so that gives you a bit of an idea. Actually, closed 3 months ago. Gives you a bit of an idea. Some people just, but that one they're at 5% deposit, so a lot of people just wanted to walk away from the deal. Wasn't worth it. It dropped more than 5% value basically. So that one is, you know, but the developer is going to be relaunching it now. They took it back. They're relaunching it back at current prices. But yeah, I mean, those assignments are interesting because you usually need a lot of cash to close on them. Usually they want the full deposit up kind of upfront, and if there's any lift, they want that too. But there's, yeah, I could see definitely some scenarios where there were people that perhaps bought maybe 2-3 years ago with interest rates being low and are a bit in hot water right now, needing to unload the contract. So I think it's definitely a possibility.
Yeah, I would just say like the only like obviously if you're in that situation then you assign it, you know, you sell the assignment, right? Like is that what would happen, Ryan?
You can, but I think some
Oh,
realtors like to. Oh, you can hear me? Yeah. So I think some realtors didn't educate their clients that it's not like a matter of just assigning. Like you need to get developer approval.
yeah,
Also, it's if you you can assign it, but they don't say if the value is lower, it's still you're making a loss now. It's not like
yeah,
you assign
right.
it, you're done with it.
Yeah.
So they're
I
like,
would say like the 2 year like that would be the worst time to do it like the 2 years ago. Whereas like now if you're doing a pre-sale, I think you're probably more in a bullish
oh yeah,
setting where like it makes sense because the market is about to go like this.
Yeah.
yeah.
Whereas like back then it was kind of like teeter-tottering downwards a little bit. So yeah,
Those assignments are hard to sell.
And
they
they're
are
paying the
risky.
you're buying a $800,000 piece of paper, so it's kind of
Yeah,
like with no showroom even to show the unit, with no viewfinder. Like you're just literally
yeah,
shutting a contract with a floor plan, and that's it. Like it's kind
yeah.
of it's not a great way to display the product and get top dollar for anything.
I just want to first of all thank Ryan and Steve for joining for the Q&A portion. Your insights definitely beneficial. We will be sending this recording out to everyone after the session. So if you came in late or missed part of it, you will get the recording. If you want to add Kevin and Ryan social, we're pretty active, not as active as Ryan and Steve, but we're happy to answer any questions that you guys might have.
This session was really great. Thanks, Ryan and Steve, for hopping on, Brandon for organizing initially with me. And, the one piece of advice is just, I'd say just surround yourself by people you trust. I live myself, like live my life doing good, and that's all I try to do, right? So, if you bring me into your fold, I'm gonna do the best I could possibly do, right? And I think every person that's on this call, Brandon, Ryan, and Steve, would say the same thing. So thank you, everybody.
Absolutely.